TDS, GDS, debt service ratios, liabilities. You might often speak to your bank or mortgage broker and just wonder what this foreign language they're speaking is. We call it nerd talk around here, but we fully acknowledge that a lot of that language is totally foreign to you, and that's okay. So I'm here today to try to explain a little bit to you about how mortgage qualifying works and what we look at. A lot of people often come to us and they think that, it's just crazy that they can't get approved for a mortgage based on a certain level of assets they have or different situations. And although every single mortgage application is different and everybody is evaluated on their own personal finances and their entire situation is always different, on a general scope, I'm here to explain to you what we often look at in order to qualify somebody for a mortgage. So on this one hand, we mostly talk about what your income level is. And on this other hand, we mostly talk about what your monthly debt obligations are. And this can be a little bit confusing for some people sometimes. As somebody who might have a very high loan, a large loan, but maybe the payments on it are quite low. So maybe they've got a $500 trailer loan or $50,000 trailer loan, but the payments are only $250 a month. What I actually really mostly only care about is what your monthly debts are. And I think that this is where there is a lot of confusion and sometimes some underlying frustrations when it comes to getting a mortgage. So in this bucket, I look for your income, whether it's self-employed income or if it's salary income. We can use child tax benefit, we can use child support income, we can use pension income, we can use investment income. And we, using our calculations, have to ascertain how much your annual income is, putting all of those pieces together. So we have different ways of looking at that. If you have salary income, that's quite simple. If it's pension income or investment income or self-employed income, we sometimes have to look at a 2-year average, but we ascertain in this bucket what your annual income is that we can use to qualify you for a mortgage. Once we've done that, we then go to this side of the spectrum and we ascertain what are your monthly debt obligations. So things like that might be, what is your monthly car payment? Do you have a trailer payment? Do you have a child support payment monthly? And some of those that are very clear are very easy to put in. If you have a line of credit or you have a credit card outstanding or anything like that, we typically have to take 3% of that balance and add that as your monthly debt obligation. So sometimes this can get frustrating for people if they have a larger line of credit that's, say $10,000, but we have to use 3% of that as a monthly payment, when in reality that it doesn't cost you that much to carry a $10,000 line of credit. Other monthly debt obligations that we have to include there are a heating expense. So we typically, even though it might cost more or less than $100 to heat your home, we have to put in there the heating expense for your home, as well as the tax payment, the monthly tax payment for your property taxes. And then for your new home, we also have to input what the mortgage payment will be. The even more confusing part about that is when we input that monthly mortgage payment, we have to put it based on the stress test. So even you might come to us today, we might get you a mortgage at 1.7% interest. We have to calculate that theoretical new mortgage payment as if you're paying 5.25% interest, which can be way more. And that's where some people might try to calculate their own debt service ratios, and though that ratio might seem off and they say, well, I've calculated it myself and it's not as you have laid out. And that's where the confusion does come in, is there's all these underlying aspects of how we have to count your current debts or the new debt you're acquiring from the mortgage, which throws everything off. Anyway, what we end up doing is we take your monthly income and the monthly debt, and we have to do a mathematical formula dividing the two, and then that percentage is what we have to use to consider your debt service ratios. So the general rule of thumb is we like to see your TDS, or total debt service ratio. So meaning the total amount of your debt, including the new mortgage, must be under 44% your total income. And this is kind of how we determine what your maximum mortgage qualifying is. There's another underlying calculation under there as well, which is called GDS, or gross debt service ratio, which means the total amount of just your mortgage, your property taxes, and your heating must typically stay between, depending on your credit score, 35 and 39% of your total income. So I know that's a lot of nerd talk and that's super confusing, and there's a lot of calculations that are underlining all of that, but I kind of wanted just to come on and explain to you a little bit on, what we're looking at. And don't get me wrong, there are some net worth programs out there where we don't so much look at what the debt service ratios are, if you've got a certain level of net worth and a certain level of down payment. But I would say on a general scale, if you're looking to get qualified for a mortgage, you've kind of got the minimum amount down, you're, a pretty normal as far as, 5% down, or just a general calculation. We do look at the income versus the debt to come up with your debt service ratios, and that's how we determine what your maximum qualifying is. But don't get me wrong, I know that's super nerdy and it's not your job to figure that all out. The first step is to give us a call. We will do the mortgage application with you. We'll determine what we can use for your income. We'll help you calculate what your monthly liabilities are. And then from there, we'll tell you what your maximum mortgage amount you can qualify for is. Have a great day.